Hello friends, James Stevenson back with another edition of Who's Hating Hard on Tesla Today? A series in which I share with you the thoughts expressed by Tesla haters, usually on Twitter or in the articles they write for Seeking Alpha, etc., about why they believe Tesla is doomed and the competition is coming and the growth story is over and the demand cliff is imminent. It's always coming next quarter, the demand cliff. And TSLAQ has been claiming this every year. I'm not kidding. Literally every year they've been claiming this, that next year the competition is coming, and next quarter the demand cliff is coming for Tesla. And every year Tesla posts growth in deliveries and revenue. All right, so the question may occur to you, when are these guys going to throw in the towel, give it up, and do something else with their day besides trolling people who like Tesla on Twitter and telling them that the stock is overvalued? So without further ado, let's roll the Who's Hating Hard on Tesla Today sizzle, and then I'll share my desktop with you. By the way, Loki is on assignment in the United Arab Emirates. So here's a tweet from James Cat in which he asks the question that I just asked, which I thought was a pretty good topic for a video. When do #TSLAQ throw in the towel the folks that never even saw #Tesla delivering 245,000 cars in 2018, and then it grew in 2019 and 20 and 21. Do they throw in the towel this year after about 1.4 million deliveries? When do these otherwise sane people admit they are wrong and acting irrationally about the growth story being over, right? So one of the longtime Tesla haters, Jon Bryant, jumped in, asking some questions. Do you actually understand that Tesla is valued as if it will be selling 15 million vehicles? But because Jon says so, we'll have to take his word for where he came up with 15 million vehicles. Why would any bear change their mind when Tesla won't deliver 10% of that number this year? Maybe because the stock market values the present value of all future cash flows. That's what a valuation is. That doesn't make any sense, Jon says. James Cat says that's just not true. Tesla has the same PE as Amazon. Look at the growth rate projections. Does that make sense to you? And Tesla's profitability will keep accelerating with Berlin and Austin kicking in operating leverage, producing vehicles more profitably than Fremont does once ramped. Even if we completely ignore everything out of their core, Q3 is 20% net margin and growing. Amazon's net margin is 2% and shrinking. Okay, so what's Jon think about that? He says, no, Tesla has no special tech or features and is in capital-intensive business. Its margins will fall, as the CFO said. Now, I listened to what the CFO says, and I don't remember him saying, our margins are going to fall. Maybe Jon can point me to what he's talking about. The pandemic was a unique time. It won't be repeated. So every year, TSLAQ has some good reason why this year was an unusually good year and that it won't happen in the future. So it was regulatory credits for a few years there. Oh, they're only profitable due to the regulatory credits, and once those are gone, they'll lose money on every car they sell, and they're going away right away. And then in Q1 of this year, Tesla reported more regulatory credits revenue than they've ever reported before. It's falling on a per vehicle basis, but the vehicles sold are rising. So even with less revenue from regulatory credits on a per vehicle basis, the total amount of revenue is increasing and adding to Tesla's earnings. But as I have mentioned many times previously, even without the regulatory credits, Tesla is more profitable now than its average competitor. So James Cat replied they had higher than average margins even before COVID. COVID is in fact irrelevant. They just need time to scale, which is what they're doing. Costs are falling, and they have been for years. The CFO actually said operating margin will continue increasing. Wait till you see Q3. And here's a chart provided by James Cat. Tesla ASP excluding regulatory credits, is this gray line here. So it came down from a time when Model S and Model X were most of the mix. As more and more Model 3s got sold, it drove the revenue down per vehicle. And then as the $35,000 Model 3 was reduced, it fell some more. And then as global deliveries prioritized higher option value trims, and as Tesla lowered prices some, it fell, bottoming in Q1 of 21, and Tesla has been raising prices since. Then the other one here is the automotive gross margin percent excluding regulatory credits. That's the red series here. And then both of these have a trend line over them. So even though ASPs have been falling, gross margin excluding regulatory credits as a percent, which is on this right y-axis, has been increasing steadily. All right. So after that, Doug Kimbrough tagged me into this conversation, which is how I found it. Couple this with James's quarterly ramp curves showing volume more than doubling every 2 years, and everyone should have a good picture of where Tesla's headed. Fast, profitable growth. Well, what does our featured hater of this episode have to say about that? Yeah, because some Tesla fanboys say so. So Jon expects us to take his word for it because he says so. Yeah, just because some Tesla fanboy says so. What about actual fundamental analysis, which we're sure you're doing a lot of, Jon? What about the fact that Tesla doesn't make money in the US and hasn't reversed its valuation allowance? This is some tax stuff. That even if Tesla takes it, will get backed out right away by Wall Street, so it has no impact on adjusted earnings when it happens. What about the increases in raw material prices and the share losses? The share losses. Nope, we'll take made-up charts. Made-up charts. So I had to reply to that. If you don't like James Catt's chart, here's my version of it, and while I'm sharing charts, it's not just gross margin per cash delivery that will continue holding up well. Tesla is rapidly growing global deliveries. If Tesla uses its US DTA, will you abandon TSLAQ? So back to the core question of this video, when is TSLAQ going to give it up? What does it take? What number do they need to see before they realize they've been wrong this whole time? So here's my version of James Catt's chart. Same idea, except this line I made a mountain range, and the other line I made column chart. But we're both excluding regulatory credits from that. And then this other one is also excluding leased vehicles to show you the revenue per cash delivery. I did a whole video on this chart as part of my Q3 2022 forecast review video series, so I won't talk about it here. So Jon says, no, what is unclear to you guys? Tesla is priced to dominate the industry. It's obvious it won't. It will be a niche player at best. This isn't hard. I have been very consistent. He has. He has been very consistent. You know, Netflix bulls thought they were right, but they weren't. They overestimated ultimate share. The fact that Tesla hasn't reversed its valuation allowance, let alone used up its DTAs by now, should be concerning. It's not because you are convinced you were right. Why are wait times collapsing everywhere? What does that imply about order in numbers? Why layoffs? Well, the backlog is coming down some, but when the backlog was going up, you were saying that meant Tesla was doomed because they were unable to produce enough. So now that it's coming back down and wait times are getting shorter, which is better for buyers, that also means Tesla is doomed. I made a TSLAQ logic flowchart you can reference to see why both of those are bad and mean Tesla is doomed. Why did Reuters report Tesla won't be producing at full strength? You know, the article before Tesla leaked stretch goals? So this is news out of Shanghai that they'll be operating at like 93% efficiency instead of 100% efficiency. Well, duh. No factory operates at 100% efficiency. There's downtime, right? I think Shanghai has one planned half day of maintenance, where there are no cars produced every week. So right there, Rob Maurer pointed out, you've got some inefficiency to dock from the 100%. Why won't the Y suffer the fate of S and X? What's the fate of S and X? Those are still two very good selling vehicles in their price class. Do you believe that a company that has to discount when it has 1.5% share is likely to get to 20% share? Well, Tesla has been raising prices for the past year and a half, but TSLAQ has reasons for why that is. You think assuming pandemic trends continue is in the least bit logical? Do you even attempt to break down the differences in financial performance in the US and China? Well, yeah, I do. I have a very detailed model. What do you have, John? What are the accounting assumptions in China? Can that be replicated in Austin or Germany? If so, what? Well, hold on, let me not dismiss this question instantaneously. What are the accounting assumptions in China? I mean, what does that question even mean? Can that be replicated in Austin, Germany? Oh, maybe he means can Austin and Germany be as profitable per vehicle as China is? Well, maybe not at the gross margin line, but they'll be saving money on distribution because they won't have to ship vehicles halfway around the world. So there's some offset there. I mean, maybe they won't be as profitable on a per vehicle basis, but it's more efficient to have factories on every major continent where your buyers are. So Tesla needs to produce a lot more vehicles. They can't produce all of them in China, right? It's fine if not every factory is as profitable as China is. Do you believe that Tesla will start gaining share in EVs? If not, how do they... Oh, this is the EV market share business. So I made a video about this you can go check out. If not, how do they get their goals for 2030? What kind of return do you assume for Tesla by year that makes it worth holding at this point? Well, I have a whole forecast video review series that explains that if you'd like to watch it, John. And what percent of US GDP would it be based on market cap? That's always a funny question. Just a top-of-the-mind list. I don't expect or want engagement on each question. Well, you sure made a long thread. You don't want anybody to question it? The point I'm trying to make for the umpteenth time, he says, is that there are a whole host of reasons for one to be bearish on Tesla. Yeah, you've had them for a long time, John. You can disagree, but don't act like there's some shallow reasoning. So I had to reply, for the umpteenth time, nobody understands how to value Tesla better than I do. Jon Bryant. I attributed that quote to Jon Bryant, and I'll show you why. In this screenshot from July 27th, 2019, Jon Bryant said, tweeted publicly, for all those that think Wall Street is against Tesla, Wall Street has been indisputably overly bullish on Tesla. Wall Street has misinformed investors, which led to funding the stock at prices higher than justified. Tesla stock was trading that day for about $16. So John believed that a $16 per share valuation, adjusted for splits, was higher than justified. All right, what else do we have here? The next year, so May the 6th of 2020, Jon Bryant was tweeting out helpfully, trying to explain to people his expert view on how to value Tesla stock. My projection is that Tesla will never have high margins and growth will disappoint, so it's about 90% overvalued, he said. Well, let's stop right there, and I'll bring up an Excel spreadsheet here. So I've been using this one to send to the other Tesla haters who say the growth story is over, there's a demand cliff coming. Every one of these green bars is showing actual Tesla deliveries by quarter. So here's where John was making his claims, Q3 of 2019, Q2 of 2020. You can see how, most quarters through there, Tesla was delivering less than 100,000 vehicles. So since that time, what did John say about growth? He said something. Growth will disappoint. So it's about 90% overvalued. Tesla is a growth stock. The share price should move on the prospects for future growth. The fact that the company can't grow Model 3 volume, let alone automotive revenue by region year over year, is damning. What was the stock price then? It was $54 per share. So if $54 per share was 90% overvalued on May the 6th of 2020, then Jon valued the Tesla Corporation at $5.40 per share, split adjusted. So yeah, the growth happened, Jon. It did, and the growth will continue to happen in the future. Here's a chart that I made a video about recently. This is just the growth from 2020 to 2021 with Tesla shown in red. This is automotive revenue by automaker. So Tesla is climbing the chart, and if you think they're done, I have a forecast for you. This is where the chart is coming from. Here's the Tesla line on the chart, just to draw your attention to it. And then you can see I've added some information over here in a box that I should probably indicate is separate. So yeah, here's the Tesla line. Tesla's revenue, as we saw on the chart, the logarithmic scale chart, was $27 billion in 2020, $47 billion in 2021. So, you know, 74% growth year over year. What did Jon say? Jon said, Tesla is a growth stock. The share price should move on the prospects for future growth. The fact that the company can't grow Model 3 volume, let alone automotive revenue by region year over year, is damning. Well, the following year it was this much revenue, and the year after that it was this much revenue. And over the trailing 12 months, it's been this much revenue. Almost $60 million over the 12 trailing months that ended Q2 2022, which is another 26% growth over half a year. So, you know, double that if you want to know how things are going. Well, it would be, it's not even double, it would be more than double, right? Because it would compound. So here's the full year 2022 projection that I have. This number is actually watered down a little by the Q2 performance when the Shanghai lockdowns limited production that could be delivered in Q2. So there's $80 billion worth of automotive revenue, which is what I expect for the full year 2022, which would be 69% projected year over year growth. I mean, Tesla on this chart in 13th place looks like it's kind of stuck in 13th place forever, but last year's number was 27, which put them behind Tata and Volvo, and right next to Mazda and Subaru. So, you know, Tesla was in 16th place a year ago. Here they are now. How long is it going to take for Tesla to climb this chart? Well, I expect this year they're going to pass Renault and Kia and Nissan and Honda this year, not next year. Unless Honda has a really good year, Tesla, I think, is going to pass them for automotive revenue this year. So they're into the top 10, up to 9th place already this year. Next year, $145 billion. Well, that would pass, if I'm right. And we know whatever you forecast, it will be wrong. That's the first rule of forecasting. If I'm right about something like 140 or 150 billion happening next year, Tesla's going to pass Hyundai, BMW, General Motors, Mercedes-Benz, Daimler, Ford, and be trailing only the top three, Toyota, Volkswagen, and Stellantis. And then I think Tesla's going to pass Stellantis the year after that in 2024. So, yeah, there's the opinion from Jon. This is the self-appointed valuation expert, Jon Bryant, and what he was publicly advising people to do. Here's what I was publicly advising people to do, which is still not trading advice and for entertainment purposes only. On June 3rd of 2019, which was over here, I said people who buy Tesla stock at 52-week lows today will be able to tell their grandkids that they bought in 2019 for less than $180 per share, which if you divide by 15 for a 5-for-1 split and a 3-for-1 split is $12 per share after adjusting for splits. And I said to buy low and sell high, you must first buy low. That's as good a place as any to leave it. I will say with that, if you've enjoyed today's Who's Hatin' Hard on Tesla today, click the like button. It's free to do that. You can also subscribe to my channel if you'd like to see more videos like this. And that would be over here. And I will see you in the next one.